Trading concentration. Firstly, for everything that we'll talk about to make an effect, we need to discuss on a few concentrating points. Are you aware of yourself in trading, or you just trading everything that comes or that moves? When you see green candles, you just buy into the market, and when you see red candles, you just sell into the market. Do you know that it's actually detrimental to your trading capital? Do you have best entry setups that you call A+? We have a set of entries that we maximize and scale in within our method. These are perfect for account growth or passing prop firm evaluation accounts. For the concept we will discuss to fully work, you will need to visit charts and compare, because chart time is important, especially for those who want to take trading as a career. Why are we talking about this stuff at the beginning of our video? It's all because this is the holy grail of trading. If you are not following any of this stuff, you are actually not on the rightful track. All right, so what is breakout strategy? Breakout strategy will always start by bias determination. So the first thing to do whenever you come to any tradable chart is to determine the market bias. Are we going to the upside or are we going to the downside? This is done with levels counting or break of market structure after peak formation low or high has been issued. In market maker method terms, we talk of a peak formation low or peak formation high. If we break structure, we actually say we have actually shifted the market direction or the market bias. Usually we need to see level 1 or the first impulse after peak formation high or low for us to determine the bias of the market. After this, we now need to see an accumulation structure. What is an accumulation structure? Let's define this. So basically we are saying big institutions cannot buy or sell at will. When they exit particular trades, they cannot just buy or sell whenever they want, like what we do. They need liquidity to fuel their entries, which is built up by confused retail traders. They create what we call motionless markets, which lures buyers and sellers. The accumulation phase can be defined as consolidation, right? What is consolidation? It is when the opening price of a day is almost equal to the closing price of that day, is illustrated below. In this particular case, we can see this is the opening price and this is the closing price. The day actually chopped in, and whatever they did in between is not necessary. What is necessary is the opening price was almost at the same line to the closing price. If we get a day of this particular form or a day of this particular characteristics, we can deem that particular day a day of consolidation. And that day of consolidation must be in a determined bias. And we've said if we are actually coming from a peak formation low, we get this day where the opening price is almost equal to the closing price, and then the breakout is basically the break of the high of that day or the low of that day, depending on the market context. But this needs to be explained on real charts. So we now need to go to the examples, but before we do so, here's something that you may like. We have monthly trading signals going for only $35 per month. These are derived from institutional market maker method, where you receive 3 to 5 depending on the market context per week, with a 70 to 75% accurate and a 2 to 1 reward risk ratio. If you want to be part of this, please use the link that I'll leave in the description box below. Let's jump over the charts. All right, so we are going to illustrate using gold against US dollar. The first thing that we are going to do is to basically determine the peak formation low, so that we know the bias, and illustrate for you so that you can replicate the war method. In this particular case, we can see that on the daily time frame, there was 1, 2, and 3. There was this choppiness, and from that choppiness, we had this particular point. This is the daily time frame. We want to find these consolidation phases within this particular rise on the lower time frames. It's unfortunate that we are now looking at this particular instance in hindsight. So in this particular case, you can see this was the peak formation low, or basically there was break of market structure going to the upside like that. After that, we can see there was a day whereby we had the opening price almost equal to the closing price, right? We were waiting to see the break of this highest price, but unfortunately the market kept on ranging within this particular phase. This was actually a consolidation phase, or basically a phase whereby the market makers were actually accumulating contracts. Within that, a break of structure is defined by a candle that breaks above and closes above with at least 75% of its body. We are saying in this particular case, we had this consolidation. This might be said it closed above, but it was not 75% of its body like this one. Therefore, our entry was going to be made at candle closure, which is this particular candlestick. And we could hold our trade up until it satisfied a 2-to-1 reward to risk ratio. Whilst on that, we can see there was another day which actually started and closed at almost same price. The opening and the closing price were at almost equal prices. And this was also a day of potential breakout. In this particular case, we had a breakout at this particular point, and the market went, of course, this was actually news-induced move whereby they wicked to the downside. Maybe it was going to be taken out. But we are saying this was a day of consolidation where we were going to make an entry. From there, we can see we had what we call a peak reset, right? This was level 1, level 2, level 3, peak reset. On that peak reset, we had confirmed that we are still going to the upside. Our job was now to look for peak formation for days of consolidation. Like in this particular case, we had an opening day, an opening price almost equal to the closing price, and a breakout actually occurred with this particular candlestick, and the market went our way like that. So basically, that is what we will be looking for. We need to see a day of consolidation or proof of accumulation for us to deem that particular day a day of consolidation. Then we break the high and low of that day. But mind you, we always need to find and understand the bias of the market. On that note, we've come to the end of our today's video. Thank you for watching, and I'll see you in the next one.